Good afternoon, ladies and gentlemen, and welcome to Vadilal Industries Q4 and FY18 earnings conference call for investors and analysts. The call has been organized to discuss the financial performance and share operating highlights with you. Today we have with us Mr. Rajesh Gandhi, Chairman and Managing Director, and Mr. Kalpit Gandhi, CFO of Vadilal Industries. We will commence the call with comments from Mr. Rajesh Gandhi and Mr. Kalpit Gandhi, after which the call will be open for a Q&A session where the management will be glad to respond to any queries that you may have. I would like to mention that certain statements made or discussed on today's call may be forward-looking statements. The actual results may vary from these forward-looking statements. The company does not offer to update them publicly to reflect changes in performance. A detailed statement in this regard is available in Vadilal Industries Q4 and FY18 results presentation shared earlier. I would now like to invite Mr. Rajesh Gandhi to commence the call by sharing his thoughts on the company's performance and progress made thus far. Over to you.
Thank you, Carl. Good afternoon, everyone, and I'd like to thank each one of you for joining us on Vadilal Industries Q4 and FY18 earnings call. I initiate the call by sharing with you key highlights and operational performance for the financial year 18. I will also to share some updates on our future growth strategy. Following that, Kalpit will give you an update on our operational and financial results for the period under review. In financial year 18, we delivered a commendable growth of 14% year-on-year in the top line on a consolidated basis. Gross margin during the year were impacted by higher raw material costs, which were based on the last season's purchase at higher prices. We also had to absorb 18% GST rate on ice cream, which exceeded VAT rates in many Indian states. The domestic business grew by 8.6% in the entire year as we had a favorable demand in the month of March, a respite from subdued consumption growth in earlier months. It is also important to note that VAL now builds X factory and does not bear the cost of transportation and storage in CNF locations. This has reduced both pricing and cost for our products, thus impacting top line. In addition, we have seen some price competition from a few local players in some of our key domestic markets. The U.S. business continued its robust growth and we recorded revenues of $8.4 million in the year. This is growth of 3 times over the last year. In the U.S., our largest market, we have been able to create a robust brand connect with our target audience, the Indian diaspora, and we are successfully selling our portfolio of premium products at healthy realizations. We have successfully leveraged the previously established process food distribution network to take ice cream to this market and have been expanding reach rapidly. We now reach around 70% of the overall market of local Indian diaspora, and there is ample room to increase penetration and distribution over the next few years. We continue to expand our distribution network in both India and international markets. We have established about 10,000 distributors last year in India and are in the final stages of implementing our secondary sales tracking software that will allow focused MIS to monitor returns on investment in sales-generating assets. In the U.S., our key export market, we now have deeper reach through 3 strategically located warehouses assisted by people and transport infrastructure. I would also like to highlight that we continue to maintain a stringent discipline in our cost and operated on an almost stable OPEX structure this year. We continue to recognize corporate debt by taking on more long-term debt in line with our capital structure, whereas working capital loans were paid down. This has led to lower interest costs during the year. Going forward, we continue to offer a wide range of quality products to our customers, keeping in mind their tastes and preferences. As an established, well-liked brand, we hope to benefit as the market shifts progressively to organized players. We see improved realizations on our continued focus on personalized packs and lower procurement prices for raw material. In addition, we see good growth from the international businesses. In financial 19, we aspire to deliver high single-digit growth in India and strong performance in our overseas business. The balance sheet in its current structure provides a strong platform for our growth initiatives. We are confident of building on our inherent strengths and deliver improved performance in the year ahead. With that, I hand over to Kalpit to discuss our financial performance. Thank you.
Thank you very much. Good afternoon, and I warmly welcome you all on Vadilal Industries Q4 and 12 months earning conference call. Mr. Rajesh Gandhi has given you a brief overview of the performance of the domestic and international business and initiatives for future growth. I will give you an update on financial performance for the quarter and year ended FY18. Revenues for FY18 have increased by 14% year-over-year on account of 8.6% growth in India business and 58% revenue growth in the international business. This growth is despite certain challenges we faced during the year. Raw material costs were higher on account of last season's purchases. In addition, we also absorbed GST-related increases in product costs in some states where it is higher than VAT. VIL is now billing ex-factory and not bearing cost of transportation and storage till CNF locations, which reduces pricing and costs for the same products. Profit for year was at rupees 16 crores versus rupees 19 crores last year, backed by a few operating challenges and investments made in international business which are yielding good returns. The focus continues to be on reconstituting outstanding debt to expand long tenure loans and reduce cost of debt. Overall debt as on March 31st, 2018 was at rupees 160 crore as compared to rupees 155 crore last year. Finance costs in FY18 lower by 4% at rupees 15.3 crore as against rupees 16 crore last year. We understand the evolving tastes of our customers and will strive to maintain our lead in innovating to deliver a steady pipeline of high-quality products suited to their requirements, all at competitive prices. Overall, we anticipate 8 to 10% growth in India and a continued healthy demand momentum in overseas markets. We aim to further strengthen our legacy brand and deliver long-term value to all our valued stakeholders. That brings me to the end of my opening remarks, and I would like to request the moderator to open the call for Q&As. We'll be happy to take any questions you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Umang Shah from JM Financial. Please go ahead.
Hi, good afternoon, sir.
Good afternoon.
Sir, I was trying to understand when you said that profits were down because of some operational issues. What were these issues?
Kalpit, you would like to answer?
Yeah, basically, as we've said, our material costs were a little higher.
Okay.
Right, that was one thing, and second is with the GST coming in, we didn't get the set-offs in the first half of the year.
For H1 FY18,
yes.
Okay. So,
which was our major spending during that time?
Sorry, sir?
Which was our major spending in terms of advertisement and diffuser purchases, which now this year we will be getting from this year onward. So that will be a little bit advantage in a coming period.
Oh, okay. Okay, all right. And sir, in our international market, when we say that we saw 58% growth in our international market, this is backed by our milk products or by other frozen foods?
This is all backed by, so we have, majority of the growth has come from ice creams.
Okay.
And that also from our US subsidiary. But on the back of this growth, obviously the frozen foods business also has grown in America.
Okay, and how are we looking at increasing our traction in our international market?
So we are, in terms of, we have the subsidiary in America, so we are increasing our distribution aggressively. We are also increasing the product portfolio, and we still continue to get, obviously, the market is also responding very positively to our marketing mix initiatives, be it adding new products or increasing distribution or increasing the advertising or multiple different activities that we are doing, hiring new salespeople, bringing transportation vehicles on board, and adding warehouses.
Okay. And sir, if you could also help me with our EBITDA margins for our international business.
So EBITDA so basically in the international business, whatever your net profit margin is the same as the EBITDA margin. Because there's we don't do any capex there.
Right.
And so you might basically just be able to add the tax impact a little bit.
Got it.
So maybe overall it's at about 10% kind of a EBITDA margin right now, given that we are spending a lot on future growth.
Okay. Okay, all right. So just one last question, sorry. In our other expenses, what all is included? Because it has grown by somewhere close to 10% over the period. So other expenses is a huge amount. So if you could also clarify that.
We need to check, I think, during the call, I think what are the expenditure covered in other expenditure?
Perfect, sir. No worries. Thank you so much.
Yeah, other expenditure must be covered.
Mr. Shah, do you have some more questions?
No, I'm done with it. Thank you so much.
Thank you. Before we take the next question, I would like to remind all participants, if you have a question, you may press star and 1 on your touchtone telephone. We'll take the next question from the line of Jasi Palia from Infina Finance. Please go ahead.
Hi, good afternoon. Sir, could you give us the number for volume growth in single serve packs and bulk packs, both in F4Q, FY18 and FY18?
No. Volume growth in pulse. Volume growth is not much. I think it's around 2 to 3%.
This is for fiscal year 18?
Yes, yes.
So what about fourth quarter FY18?
Fourth quarter, it should be 7%.
So this is only the single serve category, right?
Yes, yes. Yeah.
Got it. So, but if we, and so what's the like-to-like growth in fiscal year 18 and fourth quarter 18, adjusting for this change in pricing policy and GST, etc.? Are the numbers given in the presentation adjusted for all these impacts?
No, they're not.
So what's the like-to-like growth in sales in fourth quarter and fiscal year 18 for ice creams business?
The fourth quarter growth is higher as compared to the rest of the year. 9 months, which was 2 to 3%, and it is around 8. Fourth quarter is 20%.
So fourth quarter FY18 sales growth in absolute terms is 20%.
Yeah, that's true. Yes.
Got it. And fiscal year 18? This is adjusted for...
fiscal year 18 is 8%.
And this 20% number is adjusted for this change in pricing and GST?
Yeah. Yeah.
And so
no, not adjusted.
So what's the adjusted number?
It was not adjusted. Kalpit, earlier it was not adjusted. I think that is what Mitesh is saying.
Right.
And then it has been adjusted.
So what's the adjusted number? What's the growth after adjusting sales numbers?
We have not checked that. I'm not able to answer you immediately on that.
Got it. And so how would the RM cost move for you in fiscal year 19 versus fiscal year 18?
RM cost for the 19 looks slightly comfortable, around 2% lower than last year.
2%
so
of
far.
sales?
So far.
2% of sales?
Yeah, that's true.
And so you will buy most of your raw material in first quarter, right?
We have already purchased the measure of our dairy products in January, February, March.
Okay, got it. So
we are carrying some stock of another 4-6 months.
Got it. So this is almost realized benefit. This.
Yeah, that's very good. Yes.
Got it. And so how many deep freezers did you add in fiscal year 18 and what will be the number in FY19?
It will be like last year we added around 6,000 and this year we would have added around 8,000, 8 to 9,000.
So 8,000 is your plan for FY19?
Yes, that's it.
Got it. And sir, could you specify the sales number for ice creams outside India in fiscal year 18 and fiscal year 17?
So, FY18, the ice creams outside was about 45 crores.
Fiscal year 17, what was this number?
That must have been something like 15 crores.
How would your ad expenses move in fiscal year 19 versus fiscal year 18?
Overall, or the advertisement expenses for India are not on VIL.
Oh, correct. Yes. Yeah.
So, but VIL has basically whatever we are spending internationally.
But anyways, VIL will pay to VEL for whatever ad spending VEL is doing, right? So it might be in form of discounting the product that you said.
Right. Yeah.
So what will be the expense? Ad
so we keep it at something like 5% of
sales.
It will
remain similar levels next year.
Right. Yes.
What's your guidance for growth and margins for fiscal year 18 for both for India ice creams and outside India ice creams business?
So we've not really bifurcated that. But in terms, so your question was what's the growth in margin that we are targeting?
Growth, sorry, I want to know your guidance for growth in sales and margins.
So this coming year we are looking at high single digit growth in India.
Okay. And outside India?
Outside India we are still growing very aggressively, just like how we were last year.
Okay.
So we don't really have an idea of what kind of growth we'll get.
So it will be a high number is what you're saying?
Yes.
And how would the margins look like in outside India business next year?
So the margins in outside India, basically the way we see it is, we think long term it can be a 15 to 20% net margin kind of a business.
Okay.
So I think this year we are looking at something high single digit net margin.
Got it. And got it. Thanks. I'll come back in the queue.
Yeah.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Resham Haria from Greenedge Wealth. Please go ahead.
Yeah, hi, this is Resha. I had, so in the last call, basically you had mentioned that FY18 sales got impacted because we did not have sales generating assets like freezers. So, can you elaborate on that if, we've added more freezers and, how has that problem been solved and, how does FY19 look?
We have planned this time properly and we could deploy the fund has been managed and we could deploy the diffusers on time and So basically, it's all coordinating activities, including financing.
So would this problem no longer persist for FY19?
The diffuser problem is not there, the deployment problem is not there, but still we have to see the realization, the growth, and those things has to be seen that whether it is helping in generating a sales revenue or not.
Okay, and I missed your opening remarks, so in case if it's a repetition, I'm not sure. So what has led to, the high top-line growth in Q4 FY18? What has driven your sales growth for the Q4?
It is maybe we were aggressive in the fourth quarter in deploying the diffusers. That could be one of the reasons. The weather could be another thing, and the overall market scenario, that's what we believe. Maybe some aggression from the company side also would have helped. So it's difficult to identify specific reasons, but it is coupled of some of these reasons.
So when you say, deep freezers are not deployed, so can you please explain, how would that chain be? So when you're talking about deep freezers, would they be at the retail level, the distributor level, or how, in terms of the supply chain, if you could just pinpoint that?
No, I didn't get your question. Can you come again?
No, so when you say that, in the last financial year, we were unable to deploy deep freezers at the right time, right?
That's very true. The financings were not tied up last year.
Right.
This year it has been tied up. So that is the reason. That could also be reason of a good growth in the fourth quarter.
So when you say these deep freezers, so can you just elaborate on the supply chain of this? So these deep freezers we were unable to deploy them on time at the distributor level, the retailer level, or, how was it? So where was the bottleneck being caused?
It could be a financing also.
So basically, what I understand is that these deep freezers are deployed at the retailer level.
Right.
Right. So if you've not procured the deep freezers, then there's no deep freezers to provide to the sales team, and that kind of basically hampers the growth in the distribution.
Okay.
And that has an impact on the additional growth in sales.
Right. And for the full financial year FY18, what has been our overall growth in ice cream?
%7.
Okay, of which 2 to 3% is the volume growth, right?
Yes, that's true.
Okay. And how do you see this Q1 coming along? Because of the, it's almost over. So how was the Q1? The summer was quite inclement this time. So how would you say that this summer was better than last year's summer?
As Kalpit has already said that we are expecting a high single-digit growth. So
for the India business?
Yeah, that's
right.
Yeah.
Okay. All right. That's it from my side.
Yeah.
Thanks.
For Umang's knowledge, I think he asked for other expenditures, which includes administration, distribution, freight, power and fuel, stores and spares, and doubtful debts and those sort of things. These are the breakup of the other expenditure.
Ma'am, do you have some more questions?
No, that's it. I'm done. Thanks.
Thank you. Before we take the next question, I would like to remind all participants again, if you have a question, please press star and 1 on your touchtone telephone. We take the next question from the line of Steve Alia from Infina Finance. Please go ahead.
Sir, just want to know, in fiscal year 18, in your opinion, would you have lost market share in India?
See, it's like the industry might have grown by 10 to 15%. We would have grown by 7-8%. So slightly, you might say that.
Got it. And so, given the low base of sales for fiscal year 18, where I think you anyways have grown lower than the industry and because of some operational issues, and then I think one of the companies which was competing with you quite aggressively, I think their level of aggression has also gone down this year. So given those facts, your guidance for growth of high single digit in sales in India seems pretty low. Why is that, sir?
We are trying to work on a realization also simultaneously, improving the bottom line, getting better realization and just things, selling more value-added products. So things are being also simultaneously worked out. So that also could be one of the reasons.
Got it, sir. So, got it, sir. That's all from my side.
Yeah, thank you.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Next question is from the line of Umang Shah from JM Financial. Please go ahead.
Yeah, thank you, sir, for the clarification on other expenses.
Yeah.
So I had one more question. So when we are saying that we are going to add approximately 8,000 freezers, do we incur any capex behind this, or this is on franchise?
Obviously. This
is. So how much would be the capex behind this?
It is around 18 to 20 crore rupees.
18 to 24. And this 8,000 freezers will be added in some specific areas, or overall where all the 15 places where we are operating right now?
Overall, all the places, but like our focus is more on the northern region. So there, the number addition is slightly higher than the rest of the region.
Okay, so we are considering Himachal, Delhi,
yeah, that's true. Yeah. UP and Delhi and region.
So do we have more number of unorganized players or local players who have a higher market share in these areas, or we can we can scoop out some market share from them also?
It is difficult to get a market share from anybody. Like if you are able to grow at an average of the industry speed, I think that is also fairly good. But nevertheless, I think GST is going to help organized sector in a better way. Those who are able to take advantage of the situation, because there was an issue earlier. Now I think the government is getting more and more stricter, and the e-way bill also has been implemented all over the places. So slightly in the longer run, we see that that's going to help the organized sector.
Okay, so we are talking on sales perspective or for raw material also?
In sales and raw material both, I think. In terms of you have a lesser competition from the unorganized sector or an unhealthy competition by evasion of the taxes.
Okay. All right. Thank you.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Well, that seemed to be the last question. I would now like to hand the floor back to the management for their closing comments.
Thank you very much. If you have any questions, feel free to call or email Shiv Muthu or Carl Kola or me at our contact details provided in our presentation. Thank you.
Thank you very much.